What's going on, everybody? Welcome to a capital hungry macro higher time frame review webinar, as well as a weekly recap. So as it's still early into the new business month, it's always good to get a bird's eye view of the markets overall, and mainly on the asset classes that we focus on, and understand what's going on from a macro perspective. And in terms of the weekly recap, there wasn't really much that happened last week. So that's going to be a quick little review at the end of this webinar. But anyways, we'll start with our higher time frame analysis, and we'll just start with the dollar individually and go from the yearly time frame, quarterly, monthly, and see what still looks most high probability in terms of projections in the near future, especially understanding central banking monetary policy, market psychology, economic cycles, and higher time frame structure as well. Yeah, you're a new member, go watch the educational webinars. Don't worry, these are saved. So these are every single webinar saved. So you don't have to worry about that. People are going to rewatch this as they wish. Okay, so let's check out dollar on the higher time frame here. Now, overall, from a macro perspective, the entirety of the pandemic impact of increasing the money supply, pumping the markets at very low rates, and of course, the dollar domination phase, all that has been so far is this movement of price. So you could see, obviously, when the Federal Reserve was first having their monetary policy focus on supporting the economy, aka pumping the markets during the lockdown crashes that of course occurred during the March 2020 period, what we had take place was global economies get locked down, and then leading to economic crashes on various asset classes, like oil going to like minus $40 a barrel futures, stock market crashing to record low price points. Gold even had a very large correction, and even asset classes such crypto hit lower price points at that time before those aggressive rallies started across the board. Now, everybody obviously understood why those asset classes were increasing in value, because that crisis brought an opportunity for the rich that we see repeat through history time and time again. And as there were low prices, low interest rates, the Federal Reserve, cartel the currency of the US, jumped in to start also pumping the markets and supporting these asset classes via their asset purchase program, quantitative easing, and so forth. This also led to an increase in inflation and all of those asset classes soaring in price. But a lot of people ignore the impact to the dollar, which everybody understands dollar domination, but a lot of people thought dollar was going to be just continuing a lot more bearish from a technical perspective when you had this yearly candle close with a very large rejection at this higher time frame supply zone, and at that time respecting higher time frame bear structure as well below these key price points of interest, but not understanding monetary policy, that the only reason dollar was bearish during that time period was because the Federal Reserve exponentially increased money supply, obviously had interest rates at zero, and not just the increase of money supply, which would obviously devalue the currency, but during that time period, all of the demand in the markets from an investing perspective was in all of the various risk assets or commodities, right? Or real estate. So we saw a real estate surge during that period, crypto, stock market, commodities, and so forth. But as we understand, and what's very interesting is on the yearly perspective, you can see that you have this large bearish engulfing candle looks like dollar is going to be starting to go down to like that 80 price point and potentially visiting some historical lows. But when you go to the quarterly, what we had conveniently take place was during that time, dollar demand was lower and it was heavily oversupplied with the exponential increase in money supply. We also brought dollar down to extremely favorable higher time frame demand zones, which you can see here on the quarterly perspective. Roughly around this 90 price point. So here, when you had the initial spike up before the Federal Reserve jumped in to increase money supply, hit the circuit breaker on the stock market, and of course started to support the economy, aka pump the markets. Initially, what's also very interesting, understanding capital hungry educational webinar concepts, is the initial market sentiment impact. So when we zoom in here more, during the March 2020 period, when the pandemic came to the scene, you didn't have dollar just instantly start going bearish because that action didn't take place until, of course, the Federal Reserve jumped in. The initial impact to the dollar was being treated as a safe haven currency in terms of market sentiment. And right at the very start of the pandemic and when the lockdowns occurred, when the stock market was still initially crashing and the feds did not jump in to support the economy yet, dollar actually surged in value. But what's interesting about it is it surged in value to a very key higher time frame supply zone where you can pretty much assume the same time you had this massive spike up to this price sensitivity area, that's when the Federal Reserve jumped in to exponentially increase money supply and start keeping a loose monetary policy to stimulate the economy and support the markets. But from an order flow perspective, you really also had amazing price setups from a central banking perspective of dollar shorts from these very key supply zones, and previous historical price point peaked here during the 2017 period. And what's also interesting about that is the same exact time you had extremely great favorable buy positions that were set up on, of course, those other asset classes like the stock market, crypto, gold, oil, housing, and so forth. So what I'm trying to also explain is nothing is really random within these markets, whether it's the timing of events, whether it's the impact of events, and even where you potentially see reactions of price points of events, it's always very, very surgical and very, very repetitive, right? So keep in mind then, initial spike up with the pandemic fear, this is before the central bank jumped in, leads to more demand in the dollar just in the short term there, conveniently coming to these key supply zone of interest and better short price entry area for institutions, as all the demand when the Federal Reserve does jump in is going to be switching to the risk asset classes, equity markets, commodities, housing, and so forth. And then during the March 2020 period is when the feds, of course, took action and you had dollar plummet in value for the entirety of that year. This is when that yearly candle at the end of 2020 there ended up closing extremely bearish. But what I was saying on the quarterly time frame is then as soon as the feds pumped the markets for the entirety of that year, stock markets rose to all-time highs, crypto went to record highs, housing was soaring through record highs in North America and so forth. We all understand through the educational webinars that the cost of this was high risk inflation within the US. Now, inflation is a tool that also does increase the wealth of the ultra rich and further widen the wealth gap between the rich and poor, but it's a very, very fine line you're potentially going to cross if you start to enter hyperinflation territory and you don't start to take any action to bring that inflation down. But what's not interesting is the higher risk inflation that occurred. What's interesting is the same time that high risk inflation started to come into play and the Feds decided to take action on it and switch their monetary policy from supporting the economy to instead bringing down inflation, we came down to a very key demand zone here, creating this larger, higher time frame double bottom. But understand that when we were at these key price points and inflation's higher, the stock market just hit all-time highs, those asset classes at high prices. So now you have a very convenient potential switch of order flow where the stock market buyers start to liquidate positions and transfer that liquidity into dollar from way lower favorable price points of interest, because at the end of the day, through this entire timeline, outside of this initial spike, which was just before the central bank jumped in, and at the end of the day, that's just looking like a price setup as well. Right after that, what's been holding the most weight to this current day in dollar movement and other asset class movement is, of course, the Federal Reserve monetary policy, because they are the cartel of the currency. They dictate where the market demand is going to go based on their monetary policy, and all the institutions and whales ride that wave and follow the Fed, right? But there's a few things we have to note here and understand. When we had that liquidity shift and huge exiting of positions of whales in the crypto markets, in oil, in housing, in the equity markets as well, because remember, at the pretty much the near the end of 2021 is when we entered that bear market on the stocks and we're no longer printing any new highs. Crypto went all the way from 70K in the example of Bitcoin down to like 20, 30K at that point. Oil was starting to have a large correction from $100 a barrel going back down to 70. That liquidity is moving somewhere, right? And that liquidity is going back into cash, or sorry, the dollar here, from these very key low points from a historical perspective that we haven't seen since 2017, 2018, all the way back to roughly the 90 price point. Then you have this complete shift where all the demand was in the dollar at that time. We coined it as dollar domination because the Federal Reserve completely flipped the monetary policy on its head compared to what we had during this period of time, right? But we all understand the events that occurred, or you should understand the events that occurred if you've gone through the educational webinars. In this webinar, I want to focus more on seeing how surgical the price points are and market timing that line up with these events that occur, right? So key recap points so far. One, conveniently and surgically, the initial fear that was brought during the pandemic before the central bank jumped in and took action, in the example of looking at the Federal Reserve in the US, dollar had more demand in it as a safe haven currency on the global scale, and conveniently came to this previous supply zone of interest here before the Feds jumped in. But look at where we went. That's the key point here. And understand at this time, when you're having dollar come to these better sell side points of interest, you're also having a complete demand shift where all the demand is going to be driven into the risk assets, as of course the market's going to follow the cartel, the currency that leads the way, being the Federal Reserve, right? And then obviously we understand that this was the money pumping phase. even from within this candle itself, because you can see you had this huge spike up, but that quarterly candle still closed well back below these candle bodies, you can see, and had a monstrous rejection there. The following quarterly period almost partially filled it 50% before continuing. So after that spike up, still within that quarterly period, as March 2020 is when the Fed, of course, took action there. This was the money pumping phase. Market pumping phase. Right? But what's interesting is the money pumping phase lasted for that rough year right there, but conveniently brought dollar down to key higher time frame demanded buy areas. The same time, the Federal Reserve, the cartel, the currency, started to give signals of shifting their monetary policy. Historical just being a few years from 2017, 2018, Fed starts shifting mandate from supporting economy, aka pumping the markets, to tapering, to fighting inflation, with the first initial signals being of tapering, rate hikes discussions, etc. Right? But what's really, really interesting is you have to understand during this same time period, going towards the middle of 2021 and into 2022, the order flow, the market liquidity is going from one asset class to another as the ultra rich and elite continue to just take advantage of these opportunities being brought in the market that is seen during every crisis. And as the masses are distracted and dealing with lockdowns or having their small businesses destroyed or losing their jobs or fighting over toilet paper or wearing like tubes on their face and huge hazmat suits, there's monstrous amounts of money that was being increased in supply, pumped into the markets, and then that wealth also being distributed to all the people at the top there that are taking advantage of these opportunities being brought. Even from a smaller perspective, in my own experience as a day trader, this crisis brought me great opportunity because I played dollar domination for the entirety of 2022 and made a lot of money on gold. You know what I mean? But it's just extremely interesting how you come to those key price points of interest. Now, obviously, we understand the events, but look at the price points. So here, this was the dollar domination phase. Inevitably markets pricing in tightening of financial conditions. Remember, dollar's world reserve currency, right? What is proof of this? We were seeing in the newsroom smaller emerging countries struggling to pay back debt with obviously high global inflation, and on top of that, low economic activity, and that debt being denominated in US dollars and dollar value surging, right? it's one thing to get paid in US dollars as dollar value surging, but owing debt in US dollars as it's surging is even worse, is way worse, right? Complete opposite there. You're at a disadvantage. You're losing more there, right? And the other proof of that was the impact on other country currency value, where we saw other major players such as Japan doing currency interventions, just trying to prop up yen value and prevent that free fall on USD, on the US dollar being way too strong against the yen, because you had this double whammy with Japan that they had no choice to still keep their monetary policy loose and continue to stimulate the economy, because they've been dealing with a issue different than these other major countries, where ever since the 80s crash in Japan and bubble burst, they've been trying to accelerate inflation and stimulate the economy, and have still been trying to recover from that. And the pandemic squashed any progress they did have, and they had to continue to stimulate even further and continue to focus on increasing inflation, which we still see Bank of Japan confirming to this day. But the funny part is how dollar was surging at the same time with an active rate hike cycle by the Fed, and Japan during their loose monetary policy had to go into their reserves just to prop up the yen and do these currency interventions. Or China was selling off the dollar to prop up the yuan and stop some of the upside volatility on the dollar, right? But what's very, very interesting here is we went to historical 20-25 year highs. But what's more interesting here is when dollar domination had this correction, which was about 50% of the overall impulsive move and rally we saw here, it was conveniently towards the end of 2022, obviously with the holidays, New Year's, and going into 2023, the new business year. And the main reason that dollar went bearish here and we saw a bit more demand in equities was very misleading, because at that time, we were told that inflation reports were declining, feeding into the Fed pivot prayer narrative, because we know the stock market buyers have still been hooked and addicted to the market conditions and investing environment that was active during the market pumping phase. Low interest rates, inflation still rising, asset class prices, asset purchase program of the Fed, whales riding that wave. Greed is an extremely, extremely powerful thing, right? So what we saw right at the end of 2022 going into 2023 was very misleading, manipulated data, where we were just looking to see price setups into the new year, and also from a real world perspective, keeping consumer morale and investment activity high, preventing any type of crash into the holiday season of North America and Eurozone there. And of course, keeping that morale up into the start of the new year. But what's interesting is, one, the timing of when we had that correction, two, the size of the correction being a 50% correction of this larger impulsive rally, and three, where we retested. Now you can see that previous key supply zone becomes a buyer demand area into the new year, and we retested this area with having catalyst feeding back into dollar domination for the reason why we did not break below and holding above that 102 price point. Right? So really, this correction that occurred here, it was really just based on market timing, keeping consumer morale up into the holidays and investment activity up into the markets, preventing any type of panic and crash. and feeding into Fed pivot prayer short term, but was incorrect, as the data at that time, we find out in the last CPI report with the BLS revisions, that CPI in November 2022 monthly and December 2022 monthly were still elevated. So this was really just price setups, giving a little bit of relief in the equity markets and preventing any type of panic and crash. When we have been following along FOMCs and, of course, Federal Reserve speeches and meetings, when they keep telling the public about a soft landing in the economy, they're not really talking about a soft landing or controlled downside in the economy. What they're talking about is a soft landing and controlled downside in the stock market. That's why, based on market psychology, we see that the price anatomy is night and day different of a bull market in stocks when you have the money pumping phase versus a bear market where you have the inevitable tightening of financial conditions and the interest rate hike phase. But what's very key here is if we don't break below this 50% correction point and also those very key historical points, and we don't have any data that's taking away from dollar domination, we will still be maintaining this area and starting to trend back into these highs that the global economies and markets have already been well adjusted to, right? So I know that was a little bit of a rant and a bit of an information overload, but let's just quickly review one more time. Is this webinar focus is on the key price points of interest. And we're going to look at gold, dollar pairs, stock market as well. And you're going to see how everything's really lining up and how we can't really see any more dollar bears or gold upside or stock market upside unless we have catalysts and very key price points of interest broken. And catalysts meaning data reports or Fed speeches that feed into the Fed pivot narrative, which I don't think we're going to get. So initial spike up, conveniently, not convenient, not random, not like anything out of the blue, surgically to a previous key supply zone, right? Where you have the initial panic and fear with the pandemic leading to more demand into the dollar as a safe haven currency before the Federal Reserve jumps in and takes any action. Feds jump in, keep interest rates at zero, of course, exponentially increase money supply, and say they're going to support the economy, aka bail out the markets like every other crisis seen before. And that's what central banks repeat, turning a crisis into an opportunity for the people who have access to it. It's still a crisis for the general public and general masses. They're still distracted. They're still in fear mode. They're still confused. They still think everything's random and the government and central banks trying to do the best they can to support and help them out. They got no clue. But the crisis gets turned into an opportunity, not on its own, but by the central bank, right? Great sell points of interest from an institutional perspective, where you drive down from 102 price point of interest all the way to very key demand zone and price points of interest across the board here, roughly around 90. Boom, boom, boom. And the reason why I zoomed out is you can see we were maintaining bullish market structure on the higher time frame, not just based on a trend line here, but based on here, where we had a larger impulsive move to print this high, a pullback to retest this key price sensitivity area, and still maintained above that price point, right? So it's not even just the looking at the bullish market structure and price action here. It's even looking at it from a macro perspective. Dollar's very bullish with some key price points that we can be driving up to from a historical perspective. But anyways, so money pumping phase, markets rally, crypto rally, housing rallies for that entire year, extreme optimism and greed in the markets, And obviously, dollar conveniently comes down to these key demand zones and price points of interest historically at around the 90 handle. At the same time, dollar comes to great favorable buy price points. Inflation's at high risk and already has been, but finally, the Fed says, you know what? Inflation's getting out of hand. We're no longer going to have our monetary policy mandate to focus on supporting the economy. We have to shift our job. We have to shift our focus to now combating and bringing down this inflation. And the only way to do that from a monetary policy perspective is by tightening financial conditions and raising interest rates, right? So they didn't start raising interest rates right away, but around this time period is when the Fed started to give signals of shifting out of the loose monetary policy, no more money pumping into the market, like no more asset purchase program, and starting to give signals of tapering off the asset purchase program and rate hikes to come in the near future. This is dollar domination. Now, not just dollar domination, from these better demand zone and price points, we break above those key sell side liquidity zones and last higher time frame highs, extending into new highs that we haven't seen since like the 2000s, right? Boom. Boom. So on a macro perspective, what we had take place with these new highs printed was, keep in mind the real world impact. Dollar surging in that aggressive value was taking away a lot of demand out of equities. You were obviously having the stock markets more bearish. You were having impact on emerging countries, debt obligations, other country currency value, and so forth. So conveniently, at the end of 2022 into 2023, we had a correction to retest those previous highs and still maintain overall bullish market structure and price action. Now, I don't think we're going to be coming back down and doing some type of huge correction like this unless we have a reason. The reason why we exploded in value makes sense. You had the most aggressive rate hike cycle seen in history. That huge surge in dollar makes sense. Breaking out into new historical highs makes sense. Way more demand in dollar there makes sense. This 50% correction and retesting those previous highs also makes sense. It's almost looking like where here, you didn't have to get a full pullback to retest the trend line or come all the way back down again. You just retested these highs after this impulsive move before still continuing higher. Now, what's even more interesting is this last price point of interest here that we retested. The reason why we bounced from here wasn't random. We didn't just come to this price point and had buyers come back into play for no reason. The we started to get economic data into the new year that was giving signals the Federal Reserve will tighten financial conditions further. What were those data signals and potential catalyst confirmations? Well, we found out that the inflation reports we thought we were declining from November and December were actually still elevated. CPI data was still high, still in that higher risk area, 6% plus. Non-farm payroll, extremely optimistic, 500,000 job creation, way above forecast, right? PCE data still high, PMI solid, hawkish Fed speakers, and we're having buyers come back into the market here on dollar into this new year of 2023 from way more favorable price points than continuing to stack in from highs, right? So if we still have elevated inflation figures, if we still have solid labor market data, if we still have hawkish Fed speakers, I'm not saying we're going to surge back to these highs as impulsively as those previous quarterly periods, but starting to see this type of slow and steady upside back into the highs would not be out of the ordinary at all. That would be the market pricing in further tightening of financial conditions and understanding that the main focus of the Fed, that the cartel, the currency that they have to follow, is still fighting inflation. So this gives us great information price points and also fundamental price points. We know that from a technical price point, as long as dollar's still holding above 102.5, 103, it's very bullish. We know we still have these higher time frame highs printed by buyers, potentially historical price points we can drive into the 120s, still maintaining bullish market structure on the higher time frame above the 90 price point, this being only a 50% correction of this overall impulsive move. And the reason for the correction was just misleading, manipulated data right at the end of 2022 and setting up order flow for 2023. And as we continue to watch data day after day, week after week, and month after month, if we don't have the data feeding into recession scares and Fed pivot prayers, or we don't have inflation consistently declining, then whether it's slow or steady or not, we will be chugging back into these highs, especially understanding even the timeline where the Feds are expecting us to hold rates through the rest of 2023 and probably even 2024, where if you watch the educational webinar Sebastian did on inflation, the fight on inflation is not like a light switch or some overnight process or something that's going to just take place within a year. We increase money supply in the largest fashion seen through history, like artificially exponentially increasing inflation with being the cost and sacrifice of that. That's not something that's going to be fixed by a few rate hikes and then holding those rates for 6 months or even a year. You know what I mean? Right? So on a higher time frame perspective, even when you look at how the last monthly candle closed, it's looking pretty solid here. Even if this new month does like a 50% correction of this bullish engulfing candle, you can see that last monthly candle completely engulfed out, maintaining that sell side area turned into a buyer demand zone now, but exact same price point, maintaining higher time frame bullish structure, where if we don't cancel out that bullish engulfing candle and we still have optimistic labor market reporting, high CPI reports, hawkish Fed speakers, we will be chugging our way back to the 110s and 111s. And in correlation, obviously that will mean more GBP USD bears, Euro USD bears, USD CAD buys. And what it shows us is that the market is further following the Fed's fight on inflation, pricing and tightening of financial conditions. And that means more bears on gold and bears in the stock market. Right? So the key takeaway points is from a technical standpoint, as long as dollar's holding above 102, and if we don't have data feeding into the Fed pivot prayer narrative, we're just primarily sticking to dollar domination from a bird's eye view. Right? And now, when you look at your dollar pairs, before I jump to the dollar pairs, does that make sense to everybody so far? Everybody should already understand the events and why these markets move the way they did, but the price points of interest and the timing is what I want everyone to focus on. Right? Okay, so now when you look at a pair like GBP USD, you can see it makes dollar domination makes a lot of sense. As dollar is the world reserve currency and the market continues to primarily follow the Fed as leading the pack in terms of the central banks, and of course being the cartel, the currency of the world reserve dollar, you can see we're still extremely bearish on the higher time frame on GU. Very bearish higher time frame structure as well. And after we retested this key sell side liquidity zone in previous lows, market structure, whether it's the monthly, whether it's the yearly, whether it's the 1 minute, it follows the same universal concepts, right? Of price points of interest that maintain structure. Obviously, here we're just looking at structure from a very bird's eye view and macro perspective, going all the way from like 2008 GFC crisis to looking to the current day. But the idea is still the same. It's still extremely bearish here. Bearish structure, sellers printing lower lows, just having pullback phases. Now, after we had this large impulsive downside move, as there was way more demand in the dollar, and obviously on the pair GBP USD, where the dollar is the secondary, that's going to result in more bears. We printed new lower lows. Then the same time dollar did its correction, it's pretty one-to-one here on GU, where we came to retest previous lows. So now from a macro perspective, it's just the inverse compared to the dollar. If we don't engulf that candle, or as long as we hold below these previous lows as the main first key higher time frame price point of interest, then, and we still have data feeding into dollar domination, then it might not be as impulsive compared to the initial dollar domination of 2022, but we're going to be coming down back to these low price points of 1.1, 1.05, and so forth. And there's a lot more market stability and economic stability created because we're going to be coming back to price points that economies have already seen before and been adjusted to in the near term, being 2022, right? Remember, dollar domination had Euro USD go to the parity point with the dollar of being one-to-one. Prices we haven't seen since like the 2000s. Dollar went to that price. But same idea. Look at overall higher time frame structure. Look at the key price points of interest you be reacting to. Now, we don't have, with the example of dollar or GU or Euro USD, any reason for these extended deeper pullbacks. So far, we're just retesting previous key price points shown on the higher time frame. We're same idea here. Right? If we still have high US inflation reports, labor market still relatively solid, hawkish Fed speakers, it might not be as impulsive or as aggressive, but we will be creeping our way back down to that parity point there of 1.0 flat on Euro USD. And obviously USD CAD is more just following dollar and is probably just going to be maintaining and coming back into these historical higher price points of 1.145 as long as we don't break below 1.33 1.33 flat there. Now, what's also very interesting is not just obviously we understand the impact of dollar, those events, what the market priced in, and it's very interesting of the key areas we reacted to. But even when you go to look at another asset class, like a precious metal such as gold, you can see that large rally we had take place, very similar still to the 2008 GFC, just did another retest of this very key higher time frame sell side zone in this general area of the high 1900s, right? Now imagine in the next 25 days, as this quarterly period will close up, of course, the end of this month, if we still have high inflation, optimistic labor market reporting, more demand in the dollar, and dollar continuing more bullish, equities turning a bit flatter, this candle is going to end up closing more bearish. Maybe could even close back down to like the 1800s, 1790s. And that would still be potentially just repeating this 2008 GFC with this one last squeeze into that sell side area. It looked so bullish at that time on the intraday and higher time frame, but overall here, as you had at that time of the 2008 GFC, when Ben Bernanke was the head of the Fed, we had what was called the taper tantrum, where they started to give signals towards tapering and very, very aggressive tapering into 2013, leading to more demand into the dollar and outflow of gold. Would not be out of the ordinary here if we don't have any data feeding into Fed pivot, still have hawkish Fed speakers, and still have high inflation reports as well, showing inflation has not peaked yet, which is confirmed so far. Last CPI reports, November and December, were revised. The last CPI report for January was still higher. PCE pricing is, of course, still higher. And we had FOMC meeting minutes that came out with revisions where some of the Fed speakers were still supporting a 50 basis point rate hike. It really just looked like we were setting up order flow across the board for better price points of it at better price points of interest for the new year. Dollar from better buy areas, stock market from better sell-off areas, gold from better short sell areas. As if the fight on inflation is not showing any signs of improvement and the Feds are going to continue to tighten financial conditions, the markets, as delusional as they may be and as greedy as they may be, they have no choice but to follow the Feds, the cartel, the currency. Now, obviously, when we're looking at gold here as an individual precious metal, some things we have to note are geopolitical tensions that may arise through 2023 and 2024. We have a lot of military tension between China and Taiwan, China and US, NATO and China, Russia and NATO, Russia and US individually, and you get the idea. What would be very interesting is if those tensions came into play, dollar would still be bullish as the world reserve currency and a safe haven currency. Stock market would be a bit more bearish initially with the fear, uncertainty, and doubt, but that would be an individual reason for gold to break out here. Now, what's key when you understand price points of interest is you can also start to ask yourself questions with experience and knowledge of what would we need to break above this supply zone and continue higher. In my opinion, we would need the Feds pivoting and continuing to go back to supporting the economy and dropping rates, or we would need geopolitical tensions of new war that has not been priced into the market so far. That doesn't mean the continued Russia-Ukraine tensions. We would need World War III escalations or China invading Taiwan from a physical front. And then we may see a reason for gold to break that key price point. Does that make sense to everybody? But as we continue to watch for the next month or two, these military tensions could be noise for months, could be noise for the next year. Maybe it happens in 2024. We don't know the timeline. Our job isn't to really predict that timeline. Our job is just to be ready if those events occur and understanding how to take advantage. Obviously, if it happens like very soon, like let's just say we got headlines tonight of China invading Taiwan from a physical front, obviously we're not looking for gold sells anymore. So we're not dumb, right? But until that happens, if we don't get the Feds pivoting and cutting rates, if we don't get any geopolitical tensions and new fear, uncertainty, and doubt to price in, gold just really for this new year came to retest a key sell side price point of interest for the institutions to be driving shorts back down into the 1750s and 1700s. And even still having some potential higher time frame, deeper pullback plays. What I would still see ideal is all of the military tensions and so forth being noise, having the markets further price in tightening of financial conditions, short sellers from an institutional perspective dominating here, driving price lower, and even coming down to retest structure, key previous price points, then maybe 2024, mid 2024, we start to have a war take place. then you're at better buy price points of interest too. I don't think whales really want to be loading up with potential buys up into the 1900s and 2000s without really key catalysts for that. You know what I mean? Like, for example, here, you had this huge surge during the 2008 GFC. You had this correction with, of course, the taper tantrum and the markets normalizing. But then you started to stabilize as you had the initial Russia-Ukraine tensions of 2016. You had Brexit going on. Then 2019, trade wars and Trump coming into play. Then the pandemic and then Iran tensions and pandemic. You had reasons to stabilize here and continue bullish. Here, where we're sitting at, if we don't get the Fed's pivoting or geopolitical tensions anytime soon, we don't have reasons for buys. We have reasons for sells from very key higher time frame sell price points, potentially driving down into better buy areas on a macro perspective. Does that make sense to everybody? So it's not just dollar that's at key buy areas. It's also an individual asset class and precious metals such as gold, which obviously is moving the inverse to dollar just primarily based on the impact of monetary policy and the tightening of financial conditions, where if we don't get any Fed pivot, if we don't get any geopolitical tensions, this makes a lot more sense. And even better confirms from a technical perspective is if we start to trade back below previous historical highs here, roughly in the 1800s. You know what I mean? Now, that you can see a very hard rejection on the 3-month. Look at the 1 month. It's almost looking very similar to this, where we had looking like we were going to break lower. Here we actually did break a bit lower, right? And then you have this extended bullish rally, really just looking like price setups before the taper tantrum here. Here being potentially creating that market stability and better price setups into the new year, where at that time, gold's still looking extremely bullish. You have a bullish engulfing monthly candle there, but doesn't break that key sell side supply zone roughly. Here, same type of idea, bullish engulfing candle conveniently rejects into that key sell side zone. And the reason for that was fundamental data feeding back into dollar domination, right? NFP was extremely optimistic. BLS did those CPI revisions. January CPI was high. PCE data was still high. And hawkish Fed speakers. And then here you didn't even get an engulfing candle. You still got a very aggressive bearish candle. And the bears wasn't as aggressive, but you make your way back down slow and steady, back down into those demand zone lows. As long as we don't get any geopolitical tensions of new fear, uncertainty, and doubt, as long as inflation reports are still elevated, 6% plus, or still showing any increases, as long as labor market data is still relatively tight, as long as Fed speakers still keep on the hawkish path, even though it may not be as pretty, we will be making our way down slow and steady back into the 1700s, maybe even potentially lower. We would need fear, uncertainty, and doubt, Fed pivot, or the combination of both to be extending up and breaking above the 2000s. And the same time into the new year, where gold came to a higher time frame sell price point, dollar conveniently came to a higher time frame buy price point. You see where the potential market order flow is going. Isn't that very interesting? Now, US 30 obviously trended into new all-time highs through the pandemic, and you're not going to see as much key areas being retested on the higher time frame, obviously, as we peaked new all-time highs, right? Extreme greed through the pandemic, literally from this crash point all the way into these all-time highs here. But what's very key that you can identify is more on the monthly time frame. So after we peaked those all-time highs and the Fed started to tighten financial conditions, you can see you almost had this order block and accumulation area here that we finally shifted and broke below. Right? Now we understand that this relief rally that was based on inflation, we were told declining at that time, was actually incorrect. Last month, we had a very large rejection at that key price point of interest in this bearish engulfing candle. Now we're just getting this bit of a pullback into this new business month, but the focus is going to be Jerome Powell's speech this week, and of course, the labor market data at the end of the week, NFP, unemployment rate, and so forth. If we don't break back above 34K, just from a higher time frame perspective, or even from a more intraday perspective, if we don't fully correct this bearish engulfing candle and just maintain below that 50% correction point roughly, right, give or take some liquidity grabs, maybe with Jerome Powell's speech or with NFP at the end of the week, and we still have the Feds focusing on the fight on inflation, we will be having this candle flip bearish and starting to make its way back down to price points the market's already seen before and been well adjusted to. The only way I see us breaking above 34K in the stock market is if Jerome Powell has a very neutral monotone speech, or more on the dovish side, and NFP would have to be very bad, below forecast at the end of the week, and unemployment rate rising, showing deeper recession scares and potentially feeding into the Fed pivot narrative. If we don't get those confirms, last NFP was 500,000. Feds have been back on the hawkish tip, and of course, talking about the fight on inflation. We just know, understanding market psychology, that the price anatomy is completely night and day different between a bull market and between a bear market, right? It's going to be a struggle. These delusional, greedy buyers don't want to let go. They want to keep making more money. They want the same investing environment brought back that was over here, which hence every single bottom is put in. You always have some rumor for a Fed pivot, because the Fed pivot's just pointing back that the Feds need to go back to these investing environment conditions, lower rates, go back to pumping the markets through APP and letting inflation rise the price of these asset classes so they get richer. Does that make sense to everybody? So quick summary points here for like gold, dollar pairs, equities, and so forth. If dollar from a technical standpoint doesn't cancel out this bullish engulfing candle, doesn't break back below 102, it's still very bullish. And from an order flow standpoint, structure standpoint, fundamentally, if we still have high inflation reports, optimistic labor market reporting, hawkish Fed speakers, dollar still fundamentally bullish, and we're still playing dollar domination, potentially creeping back into these highs, 109, 110, and so forth. Right? Now, we understand the impact of monetary policy in terms of tightening of financial conditions is the inverse impact compared to the dollar on gold. If gold does not correct this bearish engulfing candle, just does a 50% correction, still maintains below that 1950s 2000 sell side liquidity zone. From a technical standpoint, we're still very bearish, right? Now, from a fundamental standpoint, if we don't have any reasons feeding into the Fed pivot prayer narrative, if we still have high inflation, high PCE data, labor market still within Fed expectations, dollar still holding stable in terms of correlations, then we will be making our way back down into the 1750s, 1720s. In the example of equity markets on the higher time frame there, from a technical standpoint, we're still respecting bear market anatomy below that 34.5 price point. And the reason for that is, yes, one, that key zone of interest, but two, based on market structure, validated by price points of interest, we had new lows printed in the stock market bear market at the end of 2022, with sell orders being collected from this price point roughly below 34K. So yeah, we may continue to range and bounce around here a little bit, but if we don't break above there, or if we start breaking back below 32.5, we're still in the bear market on equities. Just had an extra large relief rally with the end of the year there, creating some more market stability and more of a soft landing and controlled downside on the stock market, preventing any panic and mass collapse. And from a fundamental standpoint, if we still have strong jobs numbers, hawkish Fed speakers, high inflation data, the Fed's not going to be pivoting for any time soon, and we're going to still be bearish and start to trend slow and steady back down to pre-pandemic highs and these lows roughly at 31K and 30K. Does that make sense to everybody? Now, last but not least, obviously that type of correlation go just apply on GU, Euro USD, and USD CAD. But last but not least is GJ. Now on GJ, we've been playing this repetition that we saw occur after the 2008 GFC crisis, right? So what's very interesting, it's better to see on the quarterly, is three different fundamental catalysts of mass market fear. One of them specifically just impacting GBP in this case, but regardless, three different catalysts brought GBPJPY to very key buyer demand zones over the last roughly 20 years. This buy-side demand zone around the 120s, we had the 2008 GFC bring us here and fail to break lower. We had 2015, 2016 Brexit being brought to the table and failed to break lower. And we had the pandemic here bring us down to these lows and fail to break lower. Once the initial pandemic impact was absorbed into the market there, what was holding the most weight was the macro rate differential of the safe haven currency here, Japanese yen, having the Bank of Japan keep an extremely ultra loose monetary policy. Even when Bank of England was stimulating their economy with low rates, it was still a rate differential because don't forget, Bank of Japan is in negative interest rates, right? So you still have that rate differential holding the most weight, but every single one of these crises has set up better buy opportunities here overall. And we've seen a very similar pattern formation at this area where you initially get a bit of a bounce, retest, and then the larger extended bullish rally. Now, the reason why we fell from here at 190 price point on GJ back down was Brexit. Recently, Brexit apparently is completed. The deals are done with North Ireland. It's official that Brexit is done. So far, we don't know. They could go back to it. You know what I mean? These political disputes can always last a number of years. But it's been going on since 2015, 2016. And PM Sunak recently came through with a deal with Northern Ireland. And obviously, that Brexit situation is looking like it's coming toward its end there. As long as we still keep that rate differential between the Bank of England and Bank of Japan, and as long as we still maintain bullish structure, this repetition of sequence of events here, coming back to those pre-Brexit drop prices, slow and steady, would not be out of the ordinary at all. We've been here before, many times before. We can go there again. And it makes sense. Here, we dropped from this price where we should have extended higher due to Brexit. Going back to those pre-Brexit crisis prices and still having Bank of England continuing to tighten financial conditions and raise rates to combat inflation, but Bank of Japan keeping monetary policy loose, it makes sense to be trending back into this area. Right? So very key points here. One, the higher time frame price points of interest that you revisit with every single crisis. Conveniently, right? It's not convenient. It's not random. It's almost surgical. And two, potentially coming back to pre-Brexit crisis prices here into the 180s and 190s, especially if we still maintain above what we can see as a higher time frame double bottom leg area across the board here, where we've had liquidity grabs exactly there before. So especially on the higher time frame, if you're holding above the 155s. Now, when you're looking more at the monthly, you can see we have a very strong support being created here at that price sensitivity area. Order accumulation below there before the breakout, liquidity grabs into this area and so forth. The pullback is still coming from new higher time frame highs being printed here that we haven't seen really since like 2015, 2016. The pullback was conveniently into the new year, retesting those price points of interest. More defined, if we cannot cancel out that bullish engulfing candle, even if we get some pullbacks on the intraday, we should be chugging our way back into the 169, 170s, potentially even going higher back into the 180s on GJ. So from key price points of interest on the higher time frame, GJ is very bullish above 156. Even more bullish above 160, even better if we start breaking those monthly highs and continuing higher. Fundamentally, as long as UK inflation is still high, Bank of England continues to tighten financial conditions. And on the flip side, Bank of Japan still keeps interest rates in the negative, ultra loose monetary policy. And of course, their unlimited bond buying program going. Fundamentally, GJ still very bullish. Now, the one thing we have to look out for that can shift our sentiment is actually very similar to gold. Another thing that can shift our sentiment and potentially lead to sells that we'd have to adapt to is new market fear via military escalations. Global military escalations, new events to price in, would take demand out of the risk currencies, GBP included, and bring a lot more demand into the yen as a safe haven currency. That would be reasons to be potentially breaking below 156 or breaking back below 152s. But we don't have any of those confirmations yet. That's just something we have to look out for. Does that make sense to everybody? But yeah, other than that, in terms of the weekly recap and review, not much to recap and review. Last week was lower and slower volume and volatility. We've just been playing secondary phases of market structure across the board, either being pullbacks or consolidations. We're really just seeing price setups for the new business month of March, and also in anticipation of the collection of interest rates to come, interest rate decisions from other central banks, Jerome Powell's speech, and all the important economic data coming up with labor market reporting, inflation figures in the next week, and so forth. So there wasn't really much to recap from last week. Last week, really just to recap, start of the new business month, markets in secondary phase of the market structure, pullbacks or consolidations, Mixed economic data also feeding into the secondary phase of market structure. Markets anticipating and setting up prices for the key rate decisions to come, Jerome Powell's speech, labor market reporting this week. Now, I don't want to make this too long, but I'm going to save and upload this, send the rest of the weekly flow, and then in a little bit, we'll do a quick little market update for some trade ideas to start out this week. Keep in mind, another quick reminder, probably going to be low volume and volatility up until Tuesday, Wednesday, Thursday, Friday. So Sunday, Monday might be a little bit slower to start the week so far. Then obviously, when we get into some of the more important economic data, Jerome Powell's speech like midweek, rate decisions are midweek as well. I'll send, you'll see that in the weekly flow, and then US labor market reporting end of the week. Okay.